On June 12th, what is expected to be the largest IPO in history is scheduled to hit the market, a $1.75 trillion company. If you own a total stock market fund that tracks the CRSP index like Vanguard's VTI, you could own a piece of it within about a week of it going public. You don't get a vote, you don't get a warning, your money just buys it. Unless you own the S&P 500, because last week, while several other major index providers quietly relaxed the rules to let this thing in, the S&P 500 looked at the same company and said no. I'm not here to tell you SpaceX is a bad investment or a good one. I'm here to show you something most investors never think about. Your index fund has a rule book, and that rule book just decided on your behalf whether you get this stock force-fed into your portfolio or not. Let me show you what actually happened. The company is SpaceX, and whatever you think of Elon Musk, the numbers on this offering are genuinely historic. They're expected to price at $135 a share, sell around 555 million shares, and raise about $75 billion. That would value the company at roughly $1.75 trillion on day one. Now, for context, the previous record IPO was Saudi Aramco back in 2019, which raised under $30 billion. SpaceX is targeting more than double that. If the prices are expected, that's the biggest one ever by a wide margin. So, a $1 trillion plus company is going public. Normally, that's a clean story. A big company lists, it eventually works its way into the major indexes. Index funds buy it over time, very orderly story. Except almost nothing about this one is normal, and the weird parts are exactly where the lesson lives. Real quick before we get into the data, if you're new here, hey, welcome. I'm Pate Butler, airline pilot, Army vet, and a finance nerd who'd rather show you the data than sell you the dream. There's a full playlist on options, my strategies, and building a real retirement plan, all data driven. All right, let's get into it. Start with the float. The float is just the percentage of a company's shares that are actually available for the public to buy and sell. Most big companies that go public float somewhere between 10 and 20% of the company. The really established names float almost everything. Microsoft floats basically all of its shares. SpaceX is floating about 4 to 5%. That's right, 4 to 5% on a $1.75 trillion company. That is a tiny slice of stock available against an enormous valuation. Why so small? Because SpaceX doesn't actually need the cash the way a normal company going public does. This isn't a startup raising money to survive. The structure gives SpaceX a public valuation, gives early investors and employees a path to cash out, and still avoids giving up control or flooding the market with shares. Here's why that tiny float matters to you. When a stock gets added to an index, every fund that tracks that index has to buy it. They don't get to decide if the price is good. They buy it because it's in the index. That's what passive investing is. Now put those two facts together. You've got forced buying from index funds on one side and only a 4 to 5% sliver of available stock on the other. A lot of money chasing very few shares. And honestly, I don't know which way that breaks on price. It could go either way. The float minimum that indexes historically required existed for a reason. It made sure funds were never forced to chase a stock there wasn't enough of. Now keep that in mind because it's the whole reason the indexes had to rewrite their rules. Now, the second problem. This company is not profitable. In 2025, SpaceX brought in about $18.7 billion in revenue. More than half of that came from Starlink, the satellite internet business. Very strong top line. But it also lost about $5 billion that year, and it has lost tens of billions of dollars cumulatively since it was founded. SpaceX was actually briefly profitable in 2024. Then it absorbed Musk's AI company, and the spending on AI pushed it right back into the red. We'll come back to that because it's stranger than it sounds. So at $1.75 trillion against this revenue, the company is trading at roughly 94 times sales. For a business losing around $5 billion a year by any traditional measure, that is an extraordinarily expensive stock with an unproven bottom line. So you've got a company with a tiny float and no profits. Historically, that combination would keep it out of the major indexes for a long time, a year, maybe 2 years. Instead, several of the index providers did the opposite. Over the last couple of months, one after another, they adjusted the rules to let it in fast. And the order they get it matters because it determines whose money buys first. Fastest of all is the total stock market, specifically the CRSP US Total Market Index, which is what Vanguard's VTI tracks. That's one of the most widely held funds in American retirement accounts. Now, the 5-day fast entry itself isn't new. CRSP has had a quick entry path for years. The problem was SpaceX couldn't meet the old minimum float requirement to use it. So in late April, CRSP added a new alternative test based on sheer float adjusted size. And SpaceX clears that one easily. The result? It can come in about 5 trading days after listing. So the first big fund to buy SpaceX probably isn't the famous tech fund everyone's watching. It's the plain, boring, total market fund sitting in millions of 401ks about a week after the IPO. Tied for fast is the Russell 1000, the big large cap index from FTSE Russell. On May 26, they confirmed their own fast entry rule. If a new company is big enough to clear their top 500 size threshold, it can come in at about 5 trading days after listing, instead of waiting months for the next scheduled update. They even added a carve out for a low float problem tied to the lockup schedule. So Russell, also about a week. Then comes the Nasdaq 100, the index behind QQQ. Effective May 1st, Nasdaq cut its waiting period to 15 trading days for the biggest new listings. It removed its old 10% minimum float requirement, but, and this is important, it didn't just throw the doors open, it replaced it with a weighting cap. So a very low float stock gets capped at roughly 3 times its actual float weight. So QQQ gets it around 3 weeks in with a guardrail on how big it can get. Now, these indexes weight by float, so SpaceX's tiny float means no single fund holds a huge percentage of it. But don't let that fool you. The CRSP total market funds, the Nasdaq 100, and the Russell trackers all have to buy, mechanically, within weeks of each other. That's a wall of forced demand, billions of dollars of it slamming into a float of just 4 to 5%. That's a lot of money chasing very few shares. That's the collision that can move the price, and you didn't choose any of it. And then there's the S&P 500. Back in late April, S&P opened a consultation. That's basically a formal proposal where they asked the market whether they should change the rules. The proposal on the table was to cut the seasoning period from 12 months down to 6 and to waive the profitability requirements for the really big companies. Well, now we know. On June 4th, S&P gave its answer. No changes. They kept the 12-month seasoning period. They kept the profitability requirement, the one that says a company has to be GAAP profitable across the test period before it can join. They kept the float standards. They looked at the biggest IPO in history and the entire wave of pressure behind it, and they held the line. So while CRSP, Russell, and Nasdaq all adjusted their rules to let this thing in within weeks, the S&P 500 specifically is now the lone holdout. S&P's broader total market index are a different story, but the flagship 500 keeps its standards intact. Under those unchanged rules, SpaceX doesn't have a near-term path into the S&P 500 at all. Realistically, not until late 2026 or 2027 at the earliest, and only if it becomes consistently profitable first. Now, something I want to be explicit about, because I don't want to oversell one index over another. I own the S&P 500. I also run a Nasdaq-based strategy that I'm a big believer in. So this isn't me telling you the S&P is the only right answer. It's me telling you that each of these indexes has a rule book, and those rule books just behave very differently. Knowing what yours does is the entire point. So if the index funds are the ones buying, the obvious question is who's selling? Who actually benefits from all this? The answer is the people who've been inside SpaceX for years, the early employees who took lower salaries in exchange for equity, the venture investors who got in early, the big syndicate running the deal. For a lot of them, this is the payday they've been waiting for a decade. And here's where the lockup comes in. Normally, after an IPO, insiders are locked up for 180 days. They can't sell for 6 months to keep them from dumping shares and tanking the price right away. SpaceX did it differently. Their structure lets insiders sell up to 20% of their locked shares as soon as the company files its first quarterly earnings report. That's weeks after the IPO, not 6 months. And if the stock is trading at least 30% above the IPO price, they can sell another 10% on top of that. The higher the stock pops, the more shares unlock for selling. So a big early pop, driven partly by all that forced index buying, actually opens the door for insiders to cash out faster. Here's my read, and it's just a guess. I think there's real selling pressure waiting once those doors open. People who took below market pay for years, finally able to cash out, are going to want to take some money off the table. But it can go the other way too. Very few shares for sale and a lot of forced buying coming in could just as easily hold the price up or push it higher. It's a tug of war between the people wanting to sell and the money being forced to buy. So here's the picture plainly. Passive money in retirement accounts is on the buy side, mechanically at a record valuation. Long-time insiders are on the sell side looking to cash out. There's one major exception, Musk himself. He learned something from Tesla, where over the years he sold down and diluted his stake. He's not repeating that here. On this deal, Musk holds the vast majority of a special class of super voting shares, which gives him roughly 85% of the voting control of the entire company, even after it goes public. That's what's called a controlled company. The public shares you can buy come with very little say, and Musk is locked up the longest of anyone, restricted from selling for a full year. And then there's the compensation package, which honestly sounds made up to me. But according to the filing, it's right there in writing. Musk is eligible for up to 1 billion additional shares. The condition to earn them, SpaceX has to reach a $7.5 trillion valuation, and according to the filing, the company has to establish a permanent human settlement on Mars of at least 1 million people. Now, I'm not making that up. A Mars colony of 1 million people is written into the pay package. And I bring it up for one reason, because it points right back at the lesson. This is the kind of company that gets bought automatically by a total market index, rockets, satellite internet, an AI company bolted on, and a comp plan that pays out on colonizing another planet. That brings me back to the AI piece, because it's the part that ties this whole thing together. The company going public isn't just a rocket company anymore. According to the filing, SpaceX is now tied into Musk's broader AI and platform world. It absorbed his AI company, xAI, which had itself already absorbed X, the platform that used to be called Twitter. So when you buy this one stock, you're not just buying rockets and satellite internet, you're also buying a frontier AI lab and a social media platform, all bundled into the same ticker. And remember how I said the company was briefly profitable in 2024 and then fell back into losses? This is a big part of the why. Absorbing the AI business and pouring money into it is what helped push it back into the red, which means the AI bet is directly connected to why it fails the S&P's profitability screen in the first place. It all loops back. So let's pull this all the way back to you, because this is bigger than just one IPO. SpaceX is just the first. OpenAI is reportedly targeting an IPO later this year, and Anthropic just filed with the SEC this week. Neither has said which exchange it will list on yet, but wherever they land, the same index rules apply. And these rule changes weren't written for one company. They were written for a whole wave of giant, unprofitable, tightly controlled companies coming to market. And that means the question stops being about SpaceX and starts being about your portfolio, because the index you hold just quietly showed you how it's going to handle all of them. If you own a total market fund, you just learned that your money can be pointed at the largest, least proven IPOs in history within days or weeks of listing, at whatever price a tiny float produces, whether you choose to buy them or not. And if a company lists on the Nasdaq the way SpaceX is, a Nasdaq 100 fund picks it up too. That's not a flaw exactly, that's just what owning the whole market mechanically means. But you should know it's happening, and if you own the S&P 500, you just watched a quality screen do the one thing it's supposed to do. It said, prove you're a real profitable, established company first, then we'll talk. That rule felt invisible and boring right up until the moment it kept the most hyped stock on earth out of the index. And once again, I'm not telling you which one is right and which one is wrong. I hold both kinds of strategies myself. The point is simpler than that. Just know what your index actually does, because it's making decisions for you whether you're paying attention or not. The real edge here was never getting in early on the next big thing. It's about understanding the structure you already own. So I want to hear from you. If SpaceX lands in your index fund at 94 times sales, do you hold it because it's part of the market? Or does it make you rethink what your index is buying on your behalf? Drop it in the comments. I read them all. If this made you look at your own funds a little differently, hit the like button. And if you want rules-based investing content that follows the data instead of the hype, subscribe. That's the entire job of this channel. Stay disciplined, stay patient, and I'll see you on the next flight.